Hi everyone, hope you're all doing good. Welcome to Trading Coach. In this video, we are going to talk about algorithmic manipulation. So, let us see how algorithmic manipulation might be the reason behind your trading losses. Whether you are an experienced trader or whether you are a new trader, it doesn't matter which category you belong to. Let us uncover the secrets of algorithms in this particular video. So, without wasting any further time, let us dive into the topic. Whenever you look at the price chart, you can see these large wicks on the price chart, right? Every time you see these large wicks, the market or the prices of that particular asset usually turns around and it changes the direction. Say for example, if you look at this particular chart over here, we can see a large wick on the downside, but right after that large wick, you can see the prices continue to climb up. Prices went up rapidly after that. Same thing happened once again. So you can see a large wick on the upside, but right after those large wicks, the prices continually fell down, right? So what are these large wicks? What do they stand for? Well, they are an indication of algorithmic manipulation. Talking about algorithms, most of you are already aware of this. Nearly 60 to 70% of the trading activity in the global financial markets usually takes place because of algorithms. Most of the time, these algorithmic activity will be invisible to most of the traders. But if you are a skilled price action trader, if you can read the price charts in a more skilled and sensible fashion, you can recognize these type of algorithmic behavior just by looking at the candles, just by looking at the price movements. And coming back to the topic, if you look at these large wicks, which are often creating the reversals on the price, these large wicks are caused by a specific type of algorithm called as mean reversion algorithm. So what are these mean reversion algorithms? Well, mean reversion algorithm is a kind of algorithm which are often employed by big institutions. Say for example, institutions like investment banks, hedge funds, or some prop trading companies, they usually employ these type of mean reversion algorithms in order to keep the prices within the range. So the sole purpose of these algorithms is to keep the prices within a particular boundary, within a particular range. So the name mean reversion technically means pushing the prices back to the mean. Whenever the prices significantly deviate from the mean, these algorithms start their activity, they get into the process, they trade against these deviations. So whenever the prices move away from the mean, these algorithms will step in, they will push the prices back into the mean. Hence the name mean reversion algorithm. So when these mean reversion algorithms get engaged in the market, they often create some kind of liquidity hunts. So what do I mean by liquidity hunts? Well, liquidity hunts are the spots where most of the traders usually get trapped. Say for example, if you look at the chart, before this specific large wick that you can see on the candle, you can see a nice support level, and most of the traders who must have taken a short trade on this particular stock must have got trapped by this particular large wick, right? This wick has trapped out most of the short sellers in the market. Right after trapping those short sellers, the prices went in the opposite direction. This is a kind of a liquidity hunt. Same thing happened over here as well. So first we had a nice resistance on the top, then we had a nice large wick on the upside, but right after that large wick, the prices continue to fall down. Here, anyone who must have traded the breakout, anyone who might have taken a long position, all the bullish traders are trapped in the market. They are hunted because of liquidity preference, and the prices have moved against. So you can see that these large wicks are often taking place at the spot where most of the traders are looking for breakout trades. So if you are one of those traders who are looking to trade breakouts, or if you are one of those traders who usually place your stop losses exactly around support and resistance, you will be prone to these kind of liquidity hunts. And right after these liquidity hunts, the prices can move sharply in one direction. And if you are a very skilled trader, you can take advantage of these type of liquidity hunts. For example, right after a sharp wick, you can take a position against the wick. For example, in this case, if you look at the chart, we can see a large wick on the downside, but right after that large wick, when we had a nice bullish candle, you can flip your position and you can take a long trade exactly over. Likewise, if you notice this particular chart, we have a large wick to the upside, but right after that large wick, when the price is close to the downside, when you saw this nice bearish candle, you can flip your trade and you can go ahead and take a short position or bearish position. This is how we can take advantage of this specific algorithmic manipulation caused by mean reversion algorithm. These mean reversion algorithms can create liquidity hunts. These liquidity hunts can be visible to us in the like large wicks. So we can take advantage of these large wicks. We can trade against these wicks. Hence, we can capture some sharp moves on the market. If you like to learn more about algorithmic trading activity, if you like to learn more about algorithmic manipulation related topics, let me know your feedbacks and thoughts in the comment section. And if you like this video, please click on the thumbs up button. We will catch up in the next video with a more interesting lesson. Have a good time.